Today, we're breaking down the brand new NEOS XSPI ETF, launching February 3rd, 2026, and comparing it to the popular High Income ETF SPYI. We'll explain how the ETF is structured, how it works, and what it could mean for investors in today's market. First, what is XSPI? At the time of recording, XSPI is the ticker name assigned to an ETF scheduled to begin trading on February 3rd, 2026. While official issuer details are limited, data from Morningstar and industry listings indicate XSPI is known as the NEOS Boosted S&P 500 High Income ETF. It is designed to deliver income from the S&P 500 while potentially offering enhanced yield through income strategies tied to options and index exposure. In short, XSPI is part of a growing group of high-income or enhanced yield equity ETFs, a category that aims to generate income beyond what a traditional S&P 500 ETF offers. By comparison, SPYI, the NEOS S&P 500 High Income ETF, launched in August 2022 and seeks high monthly income from the S&P 500 index. It does this by writing options and blending premiums, dividends, and interest into distributions. SPYI's structure targets income with the potential for some equity upside, but the distributions are typically classified in part as return of capital for tax purposes. This type of ETF is designed for investors focused on current income rather than pure index return. Now, let S compare the core structures. SPY tracks the S&P 500 index with a high-income focus, uses covered call or options writing strategies to generate premiums and income, monthly distributions. Expense ratio usually below traditional active funds, but higher than plain index ETFs. XSPI also tied to the S&P 500, but boosted to enhance income. Likely employs more aggressive yield enhancement strategies, possibly including deeper option selling or a greater allocation to instruments designed to capture option premium. Distributions are positioned to be high, potentially exceeding SPYI depending on market conditions. While both are income-oriented, XSPI may seek more aggressive enhancement, meaning higher yield, but potentially with higher volatility or risk than SPYI. In 2026, investors continue to grapple with a low-yield environment and lingering volatility. Income-focused ETFs have become popular alternatives to traditional dividend funds or bonds. Here's how the two might perform. SPYI offers moderate yield plus some index appreciation potential. Lower structural complexity compared to boosted strategies. XSPI designed to boost income. Attractive in a low-interest world. But higher yield usually comes with greater risk, including more frequent or deeper option exposure, greater sensitivity to volatility, changes potential for income drag if markets enter sustained low volatility, where option premiums shrink. In short, XSPI might outperform in periods of volatility or higher option premium, while SPYI may be more consistent in calmer markets. Choosing between the two depends on your goals. SPYI, potentially better suited to investors who want income without extremely complex strategies, those comfortable with monthly distributions. Investors seeking broader S&P 500 income exposure. XSPI, potentially better suited to investors seeking higher yield potential and willing to accept more complexity, those with a strong risk tolerance. Traders or active income-oriented investors. Neither is a pure index fund. Both adjust the standard S&P 500 exposure with yield strategies. Here, keys what to take away. XSPI is a new high-income ETF set to launch on February 3rd